let's take this conversation forward. Josh Thomas from Quantum AMC is joining us now to discuss market fundamentals and a lot more. George, good morning. Thank you so much for joining in. First up, I have to ask you on the IT space. The index is doing well. There are positive notes coming in here. Do you think the worst is over in terms of the challenges that the sector faced earlier? And what is your pick? Do you like the large cap IT or is it the mid cap space that you like more?
Yes, thanks, Ronald, for having me on the show. See, when you look at the last few quarters of IT results, the deal wins have been fairly strong, which means from a customer point of view, from a client side, there is an intention to spend. It is just that the environment was not very conducive, and therefore, most of them have kept the discretionary part of their projects on a different side. But generally, what typically happens is when the tech spend is muted for some time, that in itself creates a requirement for upgrading the technologies and things like that. And our sense is, that could happen sometime in the next year, so in the next few quarters. So one, there is a decent amount of projects which have been deferred, and that could kickstart. And the second thing is, if at all there is a lot of things, a lot of projects coming up on the Gen AI side and things. So the Indian players would get a lot of integration demands and stuff like that.
Do you have any IT stocks that you're betting on?
So we have about little more than 15% weight in the IT sector. A lot of that is towards the large cap IT names.
So a neutral call on IT. It's not an overweight with a 15% holding.
But relatively, our cash levels have been high. So on a relative basis, if you look at it, our exposure to the sector is slightly on a higher side.
What is your cash holding right now, George?
So our cash is around 15%, given the recent run-up and, many of the stocks crossing our fair value estimates. So we have been having quite a bit of trims, majorly in the consumer discretionary space.
George, I wanted to ask you about the energy space. There have been a slew of notes. We have seen crude oil prices going below that $75 per barrel mark. There's been that big merger in the Gujarat-based gas companies as well. Is there anything that you like from the oil and gas space in terms of valuations? Yes, they are still reasonable, but some of these stocks have run up a lot.
See, we hold a couple of utility companies in the portfolio. And if you look at it, even if we were to normalize the earnings, our sense is, few of them are trading around fair valuation. But given how the stocks have performed in the recent past, and then considering that, many of these earnings profile is quite volatile in nature. So some of the gas utility companies, our sense is on a relative basis compared to market, it might might outperform the markets. But some of the oil producing companies might be affected as the crude prices comes down, because many of them had a certain threshold realization spec to $75 of crude, and as crude recedes those levels, we might see some of their earnings could be impacted.
So you are saying that gas utilities tend to benefit more in the current macros versus any of these oil companies, including the downstream companies?
Yeah, the utility companies, their earnings profile would be a lot more stable, is our sense. And we have been holding a couple of them in that sense.
Since you have a high cash weightage right now, what is it that you're expecting when it comes to the market? Is it just a period of consolidation? Are you expecting a bit of a correction, a deeper correction when you will look to deploy the cash in your books? What is your expectation for the next 6 months?
See, we typically tend to take a longer term view. If I look at the next 2-year perspective, our sense is given the levels where valuations are, the return expectations should be fairly muted. So we would look for a reasonable correction, maybe 10-15% to probably deploy most of our cash. But having said that, we are bottom-up investors, and if at all any stock hits our buy limits as individual names correct, we would be happy to add. But at this level, our sense is overall market upside is quite limited, considering a lot of the future earnings is already priced in the current levels.
I know you wouldn't be able to speak about specific names, but you did say that you have the bottom-up approach, and there are some stocks which could hit the limit at which you could enter. Is there any sector, is there any space that you think is closer to reasonable valuations, or is getting to a point where you can enter?
See, the obvious value pick at this point is private sector banks. Recently, we have reallocated some of our capital towards some of the leading private sector banks. And the reason being, the credit environment, our sense is would be kind of muted, at least in the medium term. And as and when the system liquidity has already started showing some signs of improvement, and as and when that improves, our sense is, growth in some of these names could pick up, and that could reflect in the overall space moving upward. So apart from private sector banks, one other sector which we feel could benefit in the medium term is insurance space, where valuations have been fairly high for a very long time, and in the last few years, those have come to reasonable levels, and we have been able to add a couple of more names. So apart from these two sectors, our sense is IT could be one sector where earnings could surprise the consensus estimates. And to that extent, we might see some pockets of opportunities there. But the valuations there are not anywhere close to cheap levels. But there could be some bit of fill-up coming up from the earnings side.
So if we do get a 10-15% correction in which sector would you look to buy it? Because off late what's happening is that at the index level we aren't seeing corrections, but individual sectors are going through their own volatility, a bit of a decline of 10-15%. So that churn is taking place. So now if we get a 10-15% correction, in which sector will you look to deploy?
See, like I said, we don't target any sectors as such, but our sense is, if you look at from a cycle perspective, banks remain favorable. IT might see a reasonably stable earnings profile in the medium term. And then again, the other sector where the cycle is kind of favorable is pharma, but even there, the valuations are not on a favorable side. So there is no sector as such other than the ones which I mentioned, where we are kind of sensing, the valuations are very close to bottom, or where we feel, we can immediately deploy. There are few select names in few sectors, but there is no sectoral call as such, which we can point out at this point.
Okay. All right. George, it was a pleasure speaking with you. Thank you so much for joining in. So not many opportunities, there are pockets which you could be looking at, but markets are not providing those comfort levels where one can go ahead and invest into fresh names. That's the word coming in from Quantum AMC, but we'll slip into a break. When we come back, we'll discuss what's buzzing in the commodity space, as always, with Manisha Gupta.